In today's topic, we will be covering Lesson 3.4, Financial Resources Management, found in our Intro to Business textbook. The goals are to explain how budgeting relates to financial planning, and to describe two kinds of financial reports prepared by businesses. One of the reasons why small businesses often fail is that they do not manage their finances properly. Money management is a serious issue for all businesses regardless of size. You have learned that a financial plan is an important part of a business plan. Businesses must wisely manage the money they take in and pay out to become profitable and to stay in business. One financial planning document is called a business budget. A business budget is a detailed plan for meeting the financial needs of the business. It has two main purposes: 1, anticipating sources and amounts of income, and 2, predicting the types and amounts of expenses for a specific business activity, or for the entire business. The money that a business receives is called income, or revenue. Most of a business's revenue comes from sales of its products or services. The way in which the revenue comes in is important. Most businesses rely on credit, and therefore, many sales are not paid for until 30 days or longer after the sale. Financial managers use a statement of cash flow to show the actual cash a business receives and has available on a daily basis. Businesses cannot operate without spending money. The operating costs of a business are referred to as expenses. Expenses can include employee wages and benefits, advertising, rent, utilities, and supplies. The business must be able to identify and predict the amount of each source of income and each type of expense. Budgeting is an important part of that process. The budget process requires an understanding of financial information, computer skills, basic math abilities, and effective communication skills. Basic steps to follow in creating and effectively using a budget are determining the type of revenue and expenses to be included, gathering information from business records and other sources, creating the budget using available technology, distributing and discussing the budget with those who will use the information for decision making. Startup budget. The startup budget is used to plan income and expenses from the beginning of a new business or a major business expansion until it becomes profitable. Buildings and equipment must be purchased. Most startups require very large expenditures of capital to begin. Materials, supplies, new employees, licenses, and advertising are examples of what are needed before a company can begin to sell its product or service. The startup needs for new businesses can cost hundreds of thousands of dollars. Money to pay for startup costs comes from many sources. Obtaining capital through loans from a financial institution is common. Before lending any money, a lending institution will want to see a budget and business plan. Operating budget. The financial plan for the day-to-day operations of the business is called the operating budget. It covers a specific period of time, 3 months, 6 months, or a full year. This budget follows this equation: revenue, expenses equals profit or loss. All anticipated revenues and expenses are listed, and the planned net profit or loss is shown. Cash budget. The cash budget is an estimate of the money expected to be received and paid out over a specific period of time. It lets the manager know if there is a period when cash must be borrowed to meet expenses. Even profitable businesses may have times when adequate cash is not available because of high expenses or a delay in receiving payments from customers. Nevertheless, money must always be on hand to pay expenses. Financial records. Budgets are the financial plans, or forecasts, for a business. To find out if the plans have been achieved, the business needs financial records. A financial record shows the financial performance of a business. An income statement is a financial statement that shows revenues, expenses, and net income, profit, or loss for a period of time. Revenue, expenses equals net income or loss. A balance sheet is a financial statement that lists a business's assets, liabilities, and owner's equity. Assets equals liabilities plus owner's equity. Keeping financial records and statements accurate and up to date is not the problem today that it was in the past. Preparing and maintaining financial documents used to be an expensive and time-consuming process. Often done manually using paper documents, it took special care to complete, save, and protect the records. Technology today is changing the way financial information is collected. Much information is now collected using point-of-production and point-of-sale technology, such as scanners, touch screens, and personal digital assistants, PDAs. Data files are transferred from the places where information is collected and sent to the computers of the people who prepare the financial records. Technology is also changing the way financial records are prepared and maintained. Businesses use computerized financial systems that have templates for each financial record. The software completes the necessary mathematical calculations, updates records, and makes comparisons of those records with budgets. The software can even complete what-if comparisons to help managers determine the impact of changes in budgets and financial performance.